To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Friends, today we are going to learn Accounting Standard 15 on employee benefits. Well, I'm sure some people would have had some apprehensions about the standard as to it is big or it is difficult and all of that, but trust me on one thing. This is a super simple standard, and what is important in this standard is actually understanding meanings of different words. So you will be exposed to different words, and once you understand the meanings of those words, which are simple actually, once you understand the meanings for those words, you will find that this standard is a cakewalk. Alright, now let's come back to the title, Employee Benefits. What do you mean by employee benefits? Whatever employee does to the employer is with an expectation of compensation in terms of, say, services rendered by employee to employer. Now, employer has to give compensation to employee. Whatever compensation employer gives to employee during the tenure of employment, at the end of employment, at the point of joining of employment, or after employment. So basically everything that is given by employer to employee on account of this employment contract is called as employee benefit. So as I said, it could be something like joining bonus, yes, it gets covered, or something like salary, it gets covered, bonus, yes, then you want to throw out an employee and you want to pay some lump sum amount and get rid of that employee, that is also covered. Then you want to give some medical benefits to employee, that is also covered. You want to give gratuity to employee, pension to employer, give whatever you want to employee. All those things are covered by this Accounting Standard 15. So let's look at the definition. Employee benefits are all forms of consideration given by an enterprise in exchange for services rendered by employees. Let's now look at the next definition, short-term employee benefits. When I talk about short-term employee benefits, imagine we are the employee and we rendered our service in January 2018. If payment for this is due within 12 months, meaning, so from this day you count, or from the end of this month you count 12 months, and you see whether payment for this is going to be due within that period. If it is going to be due within that period, such benefits are called as short-term employee benefits. For example, if we have done our job for the month, then our salary is payable for this month. Now, January is completed, our salary is payable on 31st of January or say 1st of February. Now, it is due within 12 months of that particular period of service, right? So, if that's the case, then you call it as short-term employee benefits. But just bear this in mind, it's not salary alone. It could be salary, it could be some leave encashments, it could be some bonuses, it could be different things. But what you have to see is whether such payments are due within 12 months from the time when the service is rendered. Now, friends, one other point is, if there are any termination benefits, those termination benefits will not be included here. What are termination benefits? We will talk about later, but termination benefits will not be included here. Now let us look at the definition. Short-term employee benefits are employee benefits other than termination benefits which fall due wholly within 12 months after the end of the period in which employees render the related service. The next word is about post-employment benefits. What is the meaning of post-employment benefits? Benefits which employer has to give to the employee after the completion of employment. So now employee is no longer working with the employer, but still employer has to make some payments to employee. Such amounts are called as post-employment benefits. Again, even in post-employment benefits, we will again recall that point. This does not include termination benefits. Okay. Now, what could be the examples for post-employment benefits? Employee completed the service. Now, employee is getting some pension. That could be an example for post-employment benefits. Let's look at the definition now. Post-employment benefits are employee benefits other than termination benefits which are payable after the completion of employment. If you want to give post-employment benefits, then you need post-employment benefit plans. So what do I mean by post-employment benefit plans? The accounting standard says there could be formal or informal arrangements between the employer and employee on the basis of which employer may make those post-employment benefit related payments to employee. Such plans are called post-employment benefit plans. Let's look at the definition now. Post-employment benefit plans are formal or informal arrangements under which an enterprise provides post-employment benefits for one or more employees. These post-employment benefit plans are broadly divided into two types: defined contribution plans and defined benefit plans. Friends, have patience. You have to understand all these terminologies correctly, and if these words are understood, standard is super simple, trust me. Right. So, come back to this. Post-employment benefit plans could be defined contribution plans or defined benefit plans. First, let us talk about defined contribution plans. Now, I am the employer. If there is something like pension payment to employee, if there is certain fixed amount, determinable amount, which I as an employer pay to a fund or pay to another entity, like say there is an insurance company like LIC which is ready to manage my pension fund. Now what I am doing is simply every month I am paying, or every year I am paying certain amount to LIC. I am the employer, I am paying certain amount to LIC, and I am telling LIC, listen, you have to make pension payment to my employee. When my employee retires for certain period, you have to make the pension payment. Like this, I am making a fixed payment to LIC. Now listen carefully. This payment what I make to LIC, after I make this payment to LIC, I do not have any further obligation. I made the payment, that's it. I don't have any further obligation with respect to your pension payment. LIC will ensure that your pension is paid. Friends, what exactly are we doing here? Basically, employer had responsibility to make some post-employment payment to employee, and that burden we are shifting to whom? We are shifting to another entity like an insurance company. So instead of we paying that after the employee retires, we are shifting that responsibility onto an insurance company kind of a person, and we are telling insurance company, look, I'll make premium payment to you. You make sure that you are paying the employees after their retirement. So now what if I pay 10 rupees, 10 rupees, 10 rupees every month, but actually insurance company did not make investments properly. They should have paid 100 rupees to the employee, but they have only 80 rupees available with them. Listen carefully. I made my payments. Based on that, insurance company, what they do is they make their own investments, and maybe I made 80 rupees payment, but they would have made it 120 rupees or 130 rupees by making some investments, and they should have paid to the employee some 100 rupees or whatever kind of amount it be. What happened is insurance company did not make investments properly. 80 rupees remained 80 rupees only. They did not earn any money out of that. In such a case, when insurance company has to pay 100 rupees to employee, will they come back to me and ask me, please give me extra 20 rupees I have to pay to your employee? Can insurance company come back to me? No. Once the employer contributes, employer says, that's all, my job is done. Employee has to get 100. Will employee accept anything less than 100? No, employee also will not accept anything less than 100. So basically, who is bearing the risk now? Insurance company is taking over that risk and saying, look, I will pay. You give me this money, I will earn, I will pay. Even if I don't earn, out of my money, I will pay. So basically, it's the business of insurance company to actually manage things like this. So this kind of a plan is called as defined contribution plan. Let us now look at the definition. We will understand what exactly it means. Defined contribution plans are the post-employment benefit plans under which an enterprise pays fixed contributions. In our example also we have seen our employer was paying some 10 rupees every month or year, right? Then into a separate entity. Our separate entity in our example was LIC. It could be another fund also. Separate entity, fund, and will have no obligation to pay further contributions if the fund does not hold sufficient assets to pay all employee benefits relating to employee service in the current and prior periods. So basically, if the fund has any shortfall, if that LIC has less money than what they should pay to our employee, does LIC have right to come back to us? No, they can't. So they'll have to pay out of their pocket. So from employer's point of view, there is no further obligation. So for this contribution plan, you can take the example of Provident Fund also, right? So even in Provident Fund, you make payment to PF authorities and then rest is taken care by them. Employees will go and talk only to PF department and they will not come back to the employer, right? So that is also an example of defined contribution plan, right? Now let us come to defined benefit plan. What is the meaning of defined benefit plan? Under defined benefit plan, the company says, the employer says, I will manage and maintain that fund, and basically it is not, that responsibility is not given to some third party like an insurance company or somebody like a PF authority. No, it's not given to someone else. Employer maintains a fund and employer says, look, when employee, after the employee leaves, for payments like say gratuity etc., we will pay, we will settle, and we are not transferring that responsibility to anyone else. In the earlier example of defined contribution, what happened? The employer transferred the risk to another third party like insurance company or Provident Fund department by paying premium. But under defined benefit plan, that does not happen. But what is common in both the cases? In both the cases, from employee's point of view, employee has to get that benefit after the term of employment. I am repeating, in both the cases, employee is getting the benefit post-employment. The only difference is, after making premium payment, is employer still responsible? If the employer is still responsible, means the risk is still with employer, we call it as a defined benefit plan. But once the premium is paid to some third party, the risk is not on employer, ultimately settlement will be done by the third party. In such a case, you will call it as a defined contribution plan. Alright. So now let us look at the definition of defined benefit plan. Defined benefit plans are post-employment benefit plans other than defined contribution plans. Wonderful. Now, which of the two is good? Defined contribution plan or defined benefit plan? Both have their advantages as well as disadvantages. Now, if you talk about defined contribution plan, you are paying premium to an insurance company or Provident Fund department, say. They will manage the fund, they will earn return on that fund, and they will pay the employee. Now, they are doing business of sort of fund management. Think about it. They are doing the business of this financial management or fund management. When they do that business, obviously they will charge money from you. So basically in this they have their profit portion definitely, otherwise they are not doing charity for us. Now think about it, friends. Why don't we do it in-house? Why should we give that money to someone? Why should we give that opportunity for someone else to make profit on us? Why don't we do it in-house? The problem is fund management requires expertise, and if it's a small amount, maybe you can just say, okay fine, we'll put in an FD or we'll do mutual fund and we'll do some management. But if it's a large fund, it becomes difficult. You need to focus on that fund management. Then, now your question would be, should I focus on my main business or should I focus on fund management? So this becomes tricky for a lot of companies. So while we pay charges and commissions to the fund managers, sometimes it becomes inevitable. You need them, otherwise you can't manage all of that. Now imagine there are 4 companies, say for example Infosys, Wipro, TCS and say Tata Motors. Now all of them realize, look, we have so many employees, and for all these employees we need to maintain these, we need to do a fund management. If we independently manage the funds, we need to pay huge money to the fund manager, and each of us has to pay money to the fund manager. Why don't we all come together and have something called as a multi-employer plan? Some people call it as multi-employer plan. So basically what is this plan about? This plan is something like, instead of each of us paying a fund manager salary of some 2 crores per year, what we might do is all 4 of us will come together. We will start a plan, something like a defined contribution plan. But listen carefully, get this right. It is not that you are outsourcing to a third party like an insurance company. No, it's not outsourced to an outsider. It is basically outsourcing this to our own fund, but it's not basically fully owned by us. It is like a commonly owned and managed fund which we may start, and 3-4 employers can come together and start this, and this fund's responsibility will be to take care of the post-employment benefit management with respect to employees of all the companies who are a part of this thing. That's all. So that's what you mean by multi-employer plans. Let's look at the definition. Multi-employer plans are defined contribution plans other than state plans, or defined benefit plans other than state plans that. Now basically what do we mean by this? It could be defined contribution or defined benefit plans, but these are not state plans. So these are not payments to PF departments, etc. These are not contributions to those authorities. That pool the assets contributed by various enterprises that are not under common control. So basically there are different entities who are not owned by same person. I am assuming in that example all 4 entities are separate and they are not owned by same person. Now don't raise a technical point of TCS, Tata Motors owned by same person or not. Don't worry. So basically I am assuming that all 4 are independent enterprises, not owned by same, not under common control. Now they are all contributing assets and that fund is managing, and use those assets to provide benefits to employees of more than one enterprise on the basis that contribution and defined benefit levels are determined without regard to the identity of enterprise that the employee employs the employees concerned. So basically here this fund is going to render the post-employment benefit services to employees of all those companies which came together to form this multi-employer plan. Now let's look at the next concept, other long-term employee benefits. Friends, some companies have policies like this. Say if you complete 10 years of service, you will get some 10 grams of gold, or you will get this much amount as compensation, for having completed 10 years, like this for 25 years. Companies have policies like this. Or after you complete 5 years of service, you will be entitled to take maybe like 6 months sabbatical leave. Some portion could be paid, some portion unpaid. Like this, different companies have different policies. If there are employee benefits which are long term in nature, and these are obviously, when I say long term, these benefits are falling due beyond 1 year from the time when the service is actually done. So such benefits are called as other long term employee benefits. Let's look at the definition. So I gave you a couple of examples. Let's also look at definition. We'll talk about them in detail in some time from now. Other long term employee benefits are employee benefits other than post-employment benefits and termination benefits which do not fall due wholly within 12 months after the end of period in which employees render the related services. So basically they fall due beyond 12 months from the time of rendering services. Now let's talk about termination benefits. Friends, employers are smart, employees are also smart. Now employer does not want an employee. Now there are two possibilities. Employer can tell the employee, please go and I'll give you some 2 months salary, please leave. Something like that employer can do and ask the employee to leave. Or employer can create a plan which is so attractive for the employee that employee feels, oh, if I voluntarily retire from the company, it's better. I think I'm getting enough money. So basically employer can make a formal plan which can attract the employee to apply for that plan so that the employee can leave. So in both these cases, basically what is happening, the contract of employer-employee, that employment contract will come to an end. So basically what is happening, the contract of employment is going to be broken. But for that you have something called as a termination benefit that employee gets. So such benefits are covered by this point. So, termination benefits, when I talk about whether employee is asked to leave by employer because of which employer pays, or employee is applying suo motu, means on his or her own, to this particular voluntary retirement plan, because of which employer is making the payment. So, they are covered under termination benefits. Let us look at the definition. Termination benefits are employee benefits payable as a result of either an enterprise's decision to terminate an employee's employment before the normal retirement date, or an employee's decision to accept voluntary redundancy in exchange for those benefits. So, basically this is more like voluntary retirement. Friends, let us talk about the next concept, that is vested employee benefits. When I say vested, something like you are an employee, you have already done your work, the employer says you earned it already, you got that benefit already, something like you have done your work and look, this is some 10 grams gold coin, you achieved your target, this is 10 grams gold coin, you earned it. Now, when I say vested employee benefit, it is an employee benefit which is already earned by the employee, meaning there is nothing like of some future action what the employee should do to get entitled to it. No, nothing like that. So, employee already earned it. That is what you mean by vested employee benefits. Let us look at the definition. Vested employee benefits are employee benefits that are not conditional on future employment. Means there is no future condition that has to be met for the employee to be entitled to it. Employee already earned it. Let us talk about present value of defined benefit obligation. First, let us understand the meaning of obligation. When I say obligation, you can conveniently understand that as a liability, right? It is a burden. When I say obligation, it is a burden. When will it be a burden? It will be a burden if it is already something which has been done, cost is incurred, only then you will say it is a burden, right? If something is a cost to be incurred in the future, it is a future burden, not today's burden. So, when I talk about obligation in this context, defined benefit obligation, you joined the company at year 0, okay? You are now at year 2, 2 years of service is done, right? Now, listen carefully. You joined the company at year 0, 2 years of service is already done. For 2 years, whatever gratuity for 2 years of service, whatever gratuity you are entitled to, you will not receive now. When will you receive? An employee will receive this first if the employee completes 5 years of service, then only the employee is entitled to gratuity. Assume that employee is expected to serve to the company till 10 years or for 10 years. Now 2 years completed, 8 more years. Now at the end of 10 years, say the company has to pay to the employee, for example, some 3000 rupees as gratuity, out of which, for discussion sake, 300 rupees is attributable to the service what the employee rendered in the first 2 years. Let us say for the first 2 years, 300 rupees is the amount attributable. Okay. Now 300 rupees is the amount paid at the end of 10 years for the service rendered in this period, in these 2 years. Okay. Now, if we are at year 2, what we will do is we will discount that 300 to year 2, that 300 to present value. Listen, maybe at the end of 10 years totally 3000 will be paid to employee, but that extra amount is for the future services that we are not discounting today. So, for the period, current period and prior periods, for year 2 and year 1, whatever is the period that is already served, for that period, in future, if 300 is the amount what is going to be paid to employee, present value of that is what is called as present value of defined benefit obligation. Let us look at the definition. Present value of defined benefit obligation is the present value without deducting any plan assets of expected future payments required to settle the obligation resulting from employee service in the current and prior periods. Now here you find terminology, without deducting any plan assets. What do we mean by plan assets? That's going to be a separate definition. Now, what is the meaning of plan assets? You have to make some payment at the end of 10 years, say. That is towards employee benefits or post-employment benefits. You have to make some payment at the end of 10 years. Say that amount is 3,000. Now, what you will start doing is, every year you will start keeping some amount aside and start making investment. Maybe 50 rupees or 100 rupees or 200, whatever, some amount you will start investing every year to plan for that payment. So, to be able to make that payment at the end of 10 years, you will start making some investments. So, these investments could be into something like fixed deposits or mutual funds or some investments, or they can even be something like some payments towards some insurance policies, right? So, like that, the amounts what you are trying to accumulate as investments which will help you pay those employee benefits in the future are called as plan assets. Let us look at the definition. Plan assets comprise assets held by a long-term employee benefit fund and qualifying insurance policies. Now, let's take an example. Based on this example, we'll actually get good clarity on current service cost as well as interest cost. These are two important terminologies, right? Now, say the employee joins at year 0 and the employee is expected to work in our company till end of year 10. Okay, right. So, year 0 to year 10 is our timeline. At the end of 10 years, the employee is going to get some gratuity payment from the company, because if any employee crosses 5 years, say as per our company norms, we pay gratuity, and based on that, at the end of 10 years, this employee is going to get gratuity. Right. Now, listen carefully. At the end of first year, the employee says, look, I have done 1 year. I have contributed to my gratuity earnings, so I am going to get some gratuity money. So, this 1 year of service will make sure that employee will get gratuity at the end of 10th year. At the end of 10th year, say the amount what the employee is going to get is 100 rupees. That 100 rupees, if you discount it to present value at the end of 1 year, say is 40. Alright. This 40 will be called as current service cost for year 1. So, 1 year of service is put in and current service cost is 40 rupees. So, 40 rupees is present value of future defined benefit contribution, right? Okay, that is 40. Now, listen carefully, we are moving into something more important. From year 1, let us go to the end of year 2. This 40, as we move closer and closer to 10 years, this 40 will increase in terms of value, meaning 40 is basically the discounted value, 100 is the undiscounted value. So, 40 may become 45, 50, 50, 60 and so on, and finally the same 40 will become 100 at the end of 10 years, correct or not? So, basically in that logic, this 40 at the end of second year would become, say, 50 rupees. For convenience sake, this 40 becomes 50, meaning what we have done is the same 40 rupees, instead of calculating at the end of first year, what we are doing is that 100 rupees of first year, which will be received by the employee at the end of 10 years, if I discount it to end of second year, how much will the value be? I am just doing a calculation. Say it is 50 rupees. Okay. Now, at the end of first year, that value was 40. At the end of second year, its value is 50. What is the extra amount which you see in the second year? Don't say 50, it is only 10. Why? Increment is only 50 minus 40, that is 10. Okay. So, this gradually goes and at the end of 10 years, this becomes something close to 100. Okay. Now, friends, this extra 10 rupees is called as interest cost. It is called as interest cost in second year. So, interest cost, we understood how that calculation works. Now, what is the current service cost then? Friends, current service cost is something like this. In second year, we are putting in effort, right? Because we are putting in effort in second year, at the end of 10 years, say the amount what we would get is not 100, because we have done effort in second year also, say we are going to get 300. Alright. Now, that extra 200, whatever is going to be paid to the employee at the end of 10 years because of the service put during the second year, if I discount that 200 to present value. If I discount the 200 to present value means present value when? If I discount the 200 to present value as at the end of second year, say that comes to, for convenience sake, 100. That comes to 100. Now, what I can say is 100 is the current service cost of second year and 10 is the interest cost of second year. Current service cost is the increase in the present value of defined benefit obligation resulting from employee service in the current period. Interest cost is the increase during a period in the present value of a defined benefit obligation which arises because the benefits are one period closer to settlement. Friends, I am just adding one more small explanation for you to be 100% clear about this. Say at the end of 3 years, I am just taking another example, at the end of 3 years, the amount what the employer has to pay is say 133 rupees. Discount rate is 10%. That same 133 at the end of second year, if I discount it by 1 year, it will be how much? 121. If I discount it by one more year, it will be 110. If I discount it by one more year, it will be 100, right? So basically at year 0 it is 100. 100 is becoming 110, which is becoming 121, which is becoming 133. So basically every year interest is changing, right? So that interest in that period is changing. Now basically that cash flow is at the end of year 3 only, but 100 to 133. 33 rupees is the interest increase between year 0 and year 3. In that 33 rupees of interest increase, in first year 110 minus 100, you will call 10 as the interest. In the second year, you will say that 121 minus 110, 11 is the interest. And in the third year, you would say 133 minus 121, 12 is the interest. So basically the difference is what we mean by the interest cost. Now, say a company like Infosys can have its own internal employee welfare fund or employee benefit fund. Now, if it has its own employee benefit fund, look at the problem and advantage. The problem is you put some money towards employee benefit fund. That money is kept aside. What if tomorrow suddenly there is a requirement in the business and you pull out money from that? Think about it. So, you kept that money aside thinking that would be towards employee benefit. If you pull it into the business, the problem is that money may be used in the business and employees may not get that benefit which they are entitled to. That is one side of the story. But what is the benefit? If you manage your own fund, probably we have so many employees, lakhs of employees. Maybe it is more economical if we manage our own fund than we paying any premium to insurance companies. So, in such a scenario, we maintain something called as a long-term employee benefit fund. Now, the way in which this fund is structured is first, it is a separate legal entity. Remember, it is a separate legal entity. And once the contribution is made by employer company into that fund, that employee welfare fund or employee benefit fund, employer company cannot take money easily from that. Who can take money from that? Employees can take money from that upon retirement or meeting those conditions, whatever. So, it's basically for employees. Employer should not have any eye on that to draw money out of it. However, just imagine, you created a separate employee benefit fund. We are Infosys, we created that fund. That fund has separate team, separate employees, everything separately done. We tell all the employees, if once you retire, go to that fund and that fund will do your settlement. This is what we told the employees. Say, one specific day, there was nobody in the fund and the employee came to the company and said, look, in the fund, the people who you said would be there, they are not there. Please make my settlement. I am leaving abroad. Like this, there is an urgent requirement. Say the company made a settlement of 1 lakh based on whatever the employee is entitled to. This 1 lakh, what the company paid, the employer paid to employee, can this money be recovered by the employer from that particular fund? Yes, because employee should have normally taken that money from the fund, but employee took that money from employer here. That amount can be reimbursed by that fund to employer. That is okay, no problem. Similarly, if there is some money that is urgently needed in the business, can an employer company say, okay, look, I asked you the other day for 1 lakh rupees which I required as reimbursement, you gave, like that give me 5 more lakh rupees. Can the employer ask? No. The standard very clearly says no, there cannot be any such transaction, employer cannot take money. However, because there is a wall like that created, there is a new complication which the employers can create. Listen to what this is. Basically, there is going to be like a wall between the employer and that fund where even in remote case, if this employer company becomes bankrupt, you cannot touch that money. You cannot ideally touch that money. Hurry, that money belongs to employees, it does not belong to employer, you cannot touch that money. Because this condition is there, what if employer company transfers as much money as possible into that fund and says, okay, we don't have any money to pay any creditors, all the money went into employee fund and that's all, and close the company. And then money will be left out in the employee fund and maybe the employer tries to do some mischief. This regulation says, no, that's not the intention. If the employee liability is 100 and the money transferred by employer to that particular fund is say 150, that extra 50 which is over and above the liability towards employees can be taken back by the employer. Particularly when do things like this happen? Particularly when there is some sort of a liquidity issue or when there is a liquidation kind of a scenario, etc., or bankruptcy, then such money can come back to the employer company. Otherwise, under normal circumstances, once we transfer money into the employee fund or employee benefit fund, we are not entitled to take it back. Now, let us look at the definition. Assets held by a long-term employee benefit fund. Assets held by a long-term employee benefit fund are assets other than non-transferable financial instruments issued by reporting enterprise that are held by an entity. So, we are calling it a fund that is legally separate from the reporting enterprise and exists solely to pay or fund employee benefits and are available to be used only to pay or fund employee benefits, are not available to the reporting enterprise's own creditors even in bankruptcy and cannot be returned to the reporting enterprise unless the remaining assets of the fund are sufficient to meet all the related employee benefit obligations of the plan or the reporting enterprise, or the assets are returned to the reporting enterprise to reimburse it for employee benefits already paid. So, the first case is where I said 150 is what is transferred, but only 100 is towards employee benefit, employee obligation that is there, that extra 50 can come back. And what is the second case? The example where I gave that 1 lakh rupees was paid by the employer to the employee, and that amount this employer company is now taking as a reimbursement from that employee welfare fund. Now, let us talk about something called as qualifying insurance policy. Even a qualifying insurance policy has some similarities to that employee welfare fund or employee benefit fund what we just spoke about. So, once you transfer money into that qualifying insurance policy, you cannot take it back for company's purpose. It is generally meant to be paid or used only for employee benefit. However, things like reimbursements are permitted. Let us look at the definition. A qualifying insurance policy is an insurance policy issued by an insurer that is not a related party of the reporting enterprise if the proceeds of the policy can be used only to pay or fund employee benefits under a defined benefit plan and are not available to the reporting enterprise's own creditors even in bankruptcy and cannot be paid to reporting enterprise unless either the proceeds represent surplus assets that are not needed for the policy to meet all the related employee benefit obligations. We already spoke about something like this, or the proceeds are returned to the reporting enterprise to reimburse it for employee benefits already paid. Friends, in the examples what we took, I said something like this. The employee joined at year 0 and we are expecting that the employee will leave us at year 10. How do we know? Who can vouch for it? Employee may leave us tomorrow, right? So we do not know whether employee is really going to be with us till the end of 10 years. But we need to make an assumption and make this estimation. So the assumptions used to make that estimation are called as actuarial assumptions. They are called as actuarial assumptions. And basically, why do we call them actuarial assumptions? Friends, basically whenever high level of estimations are involved, which involve high level of statistical understanding of information, there is a science around it called as actuarial science. And there are professionals called actuaries. Like the way, we have chartered accountancy as a profession, actuary is a separate profession. So, the actuary does something called as actuarial valuation. Actuarial valuation is required when there is a high degree of estimation that is needed. Now, this is definitely an example where you need high degree of estimation, because we are saying at the end of 10 years if the employee leaves, we don't even know whether that 10 years is relevant. We might have to pay 100 rupees. We don't even know whether that 100 rupees is going to be 100 or 120 or 80. So, there is definitely a lot of estimation. That estimation, the moment I say, estimation is basically the closest approximation of an account balance at a given point of time, because there is no way to precisely measure it, right? So, using your best available information, you make the estimation. But if this is not precise, it may be different from what ultimately you are going to see. That is why the accounting standard 29 says whenever you make estimates, those estimates have to be revised or revisited periodically. Last year, that is say year 1, at the end of year 1, you made some estimate that the employee is going to be with you for 10 years. Now, at the end of year 2, you have to check whether those estimates remain good or whether they continue to be good or whether they need to change. Now, if the estimates change, if the assumptions change, those estimates also will change. So, for example, now the employee is not going to be with us till 10 years. Our revised understanding is employee might be with us only for 7 years. Now, your estimation is going to change. The change in the estimation because of change in the actuarial assumption will give rise to something called as actuarial gain or loss. I am repeating. You made an assumption. The assumption what you made changed. Because the assumption what you made changed, the estimate what you made also will undergo a change. That change in the estimate because of change in the assumption is called as actuarial gain or loss. Let's look at the definition. Actuarial gain or loss comprise experience adjustments. When I say experience adjustments, the effects of difference between previous actuarial assumptions and what has actually occurred, and the effects of changes in actuarial assumptions. So, basically something that happened during this period made us change the assumptions what we made in the previous accounting period. Now, let's talk about the last definition before we move into the rest of the standard. Past service cost. What is the meaning of past service cost? Friends, in the current period, you introduced something like a gratuity scheme, or you changed the gratuity scheme or pension scheme, any employee benefit related scheme, you changed it in the current period. Because of you changing it, the impact will be there not only in the current period. Basically, you just said all the employees who completed 3 years of service will be entitled to gratuity. Earlier it was 5 years of service. Now you introduced a policy saying everybody who completed 3 years of service will be entitled to gratuity. You became more generous in life. Now, in such a case, more employees are going to become part of this gratuity scheme. So, even those who earlier you thought wouldn't be entitled, now some people became entitled to gratuity scheme, and on that basis you are saying, oh, in the past had we known it, our calculations would have been different. But that scheme was not there in the past. That scheme came in only now. Because that scheme came only now, we will have to account for it now. But the impact of what you account now is not only because of the current period related transaction, the impact includes some years which have already passed. Something like 2 years have passed also might have calculation which comes and hits the P&L in the current period. So on account of changes in the policies what the company makes regarding the employee benefits, there would be a change. It could be positive or negative, it could be gain or loss on the assumptions and estimations made for the prior periods. That portion we call as past service cost. Let's look at the definition. Past service cost is the change in the present value of defined benefit obligation for employee service in prior periods resulting in current period from the introduction of or changes to post-employment benefits or other long-term employee benefits. Past service costs may be either positive or negative. Excellent. So now after completing the discussion of all the definitions, let us understand some important principles which we have to bear in mind when we are doing accounting standard 15. Friends, for AS15, accrual concept, prudence are super important, and also matching concept. So accrual concept you are familiar with, prudence you anyway know. Prudence basically is more like conservatism, and also we are talking about matching concept. So matching expenses, basically matching benefits with costs. So if you are expecting benefits in certain period from the employee, costs also have to get recognized in that period. So basically that matching concept. Just bear these 3 points in mind, and when we actually do the standard, I will keep referring to these principles and keep explaining, oh, look, based on accrual we are doing this, or based on prudence we are doing this, or say you talk about matching concept we are doing this. So I'll keep bringing you back to these principles. Alright, so now what we are going to do is we will just bucket all the points what we discussed into 4 categories of employee benefits. The first category is short-term employee benefits. When will you call something as short-term employee benefits? If it falls due for payment within 12 months from the period of rendering service. Then post-employment benefits. Post-employment benefits fall due for payment at or after retirement. Then other long-term employee benefits fall due for payment beyond 12 months. And termination benefits fall due when employer-employee relationship ends. So basically it is at that point of termination. Friends, one other point you should remember is when I talk about employee benefits, we are talking about employee benefits which are formally agreed upon. Some of them may be informal, but still generally they are in practice. So you know that you are going to pay as an employer, and employee knows employee is going to get that. So they might be informal, and some may be legislative in nature. So basically there is a law which asks you to pay that, and that is why you are paying. So all these come under employee benefits. However, AS15 does not talk about ESOPs, employee stock option plans, because for that we have a separate regulation and separate guidance that we have under accounting norms of ICI. So we will refer to that when we come to ESOPs. Let's now start talking about short-term employee benefits. What are the examples of short-term employee benefits? Salaries, wages, or any bonuses, some may be non-monetary compensations also. All these come under short-term employee benefits. Right. Now, there can be more words used, like some charges they may call them, or they may call these as some incentive payments. So by whatever name you are calling, all those payments which are going to be due within 12 months from the time that particular service is rendered by employee will come under short term. Now, when I talk about short term employee benefits, let's also understand 2 more relevant words: vested, non-vested. When I say vested, we already discussed these words, but I am just bringing you back to those. When I say vested benefit, it means employee already earned that benefit, employee is already entitled to that benefit. There is nothing that employee should do in the future to get that. So already it is earned by employee. In such case, you call it as vested benefit. Friends, vested does not mean it is already paid to employee. Vested means it is earned by employee. So whenever it has to be paid, it will be paid. but the point is there is no further action that is required from employee for employee to get entitled to it. But when you talk about non-vested, it basically means that employee is yet to get entitled to that. So something like you spend 6 months, then you will get that particular benefit. So in such case, it is non-vested because you have to spend that 6 months, only then you get entitled to that benefit. Short-term employee benefits. The two principles that you have to bear in mind when you're talking about short-term employee benefits are, one, you recognize them on accrual basis, right? So once this particular expenditure from company side is accrued, right? Once it is incurred as a liability, you have to, once it is incurred, then you have to recognize this particular expense. Now, when I talk about this, say salary cost, employee completed that particular month of service, employee is entitled to salary, that's all. Whether you paid salary actually or not, that has to be accounted for. So when I talk about recognition and measurement criteria, it is about when and how and at what value you record those entries, right? So the one is accrual. Second point is, even if that amount is payable after 6 months, within 12 months if it is payable, it is falling under short-term employee benefits. Even if that amount is payable after 6 months or 8 months or 9 months, you do not discount it. So these are undiscounted. These amounts are undiscounted. The reason why we avoid discounting when the period is less than 12 months is generally from materiality concept. So the standard says if it is within 12 months, by discounting you are not going to dramatically change the picture. So for that purpose, why do you really have to discount? So that is why standard just gives a general suggestion. If the period within which that particular amount is payable is 12 months, then don't discount it, just leave it at the undiscounted value. Alright. Now friends, there is salary payable. Salary payable is a liability. So basically there is a short-term employee benefit which is payable by the company, that will be a liability. Now imagine it is not something like a salary payable. You already gave salary advance to employee. You gave advance to employee and amount is still recoverable from employee. Then that same item will sit in the balance sheet as an asset, right? And friends, sometimes the salary cost what we are talking about might be salaries or wages, whatever, might be in relation to construction or acquisition of a capital asset. So there is a building under construction which is going to be our fixed asset in the future, and there are some employees who are working only on that. Their salaries, all the employee benefits what you are paying to them, that portion should not just go as an expense into P&L, that should be capitalized along with the asset cost. Let's talk about leaves. For leave, with respect to leaves, there are two broad aspects what I want to discuss. One portion is called earned leave, the other portion is called casual leave. If it is something like earned leave, what will happen is, if there are some 10 days of earned leave per year, if the employee takes that earned leave, fine, the employer is not going to deduct money for it. But if employee does not take those earned leaves, employee may have an option to either encash them or carry them forward into the future and use that leave in the future. So this option employee may have. So that is why once I say that there is an earned leave, to that extent the employer, whatever is the portion of earned leave which is not utilized, which is capable of either encashment or carry forward, you make a calculation. Okay, how many days? Acha, 10 days. Okay, what is the monthly, what is this equal to in terms of money based on the salary of employee? You will arrive at an amount. So to that extent you have to create a provision. So you have to accumulate and accrue that amount of provision with respect to earned leave. But when you talk about casual leave, it's something like this. The employee, say, is given 10 days of casual leave. So if the employee takes leave for those 10 days during the year, there will not be any salary deduction. But that does not mean that if employee does not take these, we will give cash to employee. Generally that does not happen when you talk about casual leave. So that is why with respect to casual leaves, if employee is taking those casual leaves, then to the extent what is permitted, you would have anyway paid salary without deducting that salary because it is within the permissible 10 days per year kind of limit. So, for that purpose, anyway salary cost would have gone into P&L, nothing extra has to be done in relation to casual leaves. Let us take one more example to understand what that earned leave is. Say you join a company and your company tells you that you have totally 24 days of earned leave per year, but every month 24 by 12, 2 days of earned leave will accrue to you. So, listen carefully to what happens. First month is completed. It means now you are entitled to 2 earned leaves. Okay. Now, second month is completed. You have not taken any extra leaves. So, you have 2 more leaves, 2 more earned leaves. So, at the end of second month, you have 4. Like this, at the end of third month, you have 6. Right. Now, listen carefully. You have 6 leaves which you have at the end of third month. But in the third month, you took 4 days leave. You took 4 days of earned leave. We are not talking about casual leave, we are talking about earned leave. You took 4 days of earned leave. Now, if you utilize 4 days of earned leave, there is nothing else that needs to be done for that particular purpose. But say at the end of third month, you make the financial statements. At the end of third month, you make the financial statements. Then, what is the portion of earned leave which is not utilized? 2 days, right? For that 2 days, you need to quantify in terms of amount and you have to make a suitable provision. So, you are accruing it in this particular period, right? Now, you are accruing it in this period. Those 2 days might be used in the future, that's fine. When they are actually used in the future, then you are not debiting to P&L. When are you debiting to P&L? Whenever you are actually preparing the financials for this period, that is at the end of 3 months I said you are preparing financials. So, in this period itself you are accounting for this 2 days of cost. Now, let us talk about the next category, post-employment benefits. So, under post-employment benefits, you can talk about gratuity, pension, provident fund. We also call it a these are also called as superannuation funds. So, or medical benefits, all these come under post-employment benefits. Post-employment benefits can be divided into defined contribution plans and defined benefit plans. Let's start talking about defined contribution plans and what kind of accounting we are supposed to do in these cases. Friends, I already discussed with you that in defined contribution, the employer makes a payment of fixed sum towards an insurance policy or a fund which maintains the employee settlements at the time of post-employment. So, basically something like you are paying some premium to the insurance company, and when employee actually retires and employee has to take some pension or gratuity, insurance company is going to pay to employee. So, every say month or quarter or year, there is going to be premium paid by employer towards the insurance company or that fund, as we can call it, that outside fund. So, the amount of premium whatever is being paid will be debited to P&L. So, that will be considered as an expense and that will be charged to P&L. Now, tell me, at the end of employee's term, if employee comes to that particular insurance company and asks for PF payment or gratuity payment, will insurance company ask you to make any further contribution? No. It is a defined or fixed contribution which you already paid to insurance company now, or that fund as I can call it, and whatever has to be settled to employee now is not my problem. That is going to be the problem of insurance company, right? So, there will not be any further obligation that will come on to us. Now, what if there were some actuarial wrong calculations that we made? We thought the life of the employee could be 60 years, but maybe the average of life of employee is only 55 years. What will happen if there are some actuarial errors like this or estimation errors like this which come up? Accounting standard is very clear about it. Hey, you paid some fixed amount, that's all. Based on the best assessment, you paid the fixed amount, whatever was mutually agreeable. Now, all the estimation risk, future liability, everything is on the insurance company. So, you pay that premium and you can relax. Under defined benefit plans, what you would do is, instead of giving the money to an outsider called as an insurance company or an external fund and asking them to manage, you would as well do it in-house or by having your own fund. You will have your own fund in the company and basically that employer will open one more say gratuity management fund or employee welfare fund, and they will manage the whole show. So in such cases, if there is any shortfall, you are supposed to pay 100 rupees to the employee, but based on what amount you transferred into that fund, that amount became only 80 rupees. Then who will pay the difference? You can't tell the employee it is your loss. You can't ask that fund to pay for it because that fund does not have any revenue generation other than what you pay, what you invest into that fund, and what interest or dividend etc. profit what they get. So basically if there is a shortfall, then responsibility is on the employer to fill money into that particular fund because this is our own fund and we are going to pay money to our employees on post-employment through this particular fund. So basically the risk of any estimations going wrong will hit the employer when it comes to defined benefit plans. Friends, these defined contribution plans and benefit plans what we spoke about can have something like an insurance company which I spoke about. Then we already spoke about multi-employer plans, right? And these could sometimes be state plans, like when I said provident fund, state-owned provident fund also could be there, right? So you have to bear these in mind, and according to whether they are defined contribution plans or benefit plans, you have to choose and invest money, or you have a proper channel. You should make sure that you have enough resources to pay the employees their post-employment benefits. So friends, the crux of defined contribution and defined benefit plans, as we discussed, is something like this. Is the actuarial risk meaning that actuarial estimation risk, right? Some estimations going wrong, is that risk falling on employer? If the answer is no, that risk is not falling on employer, we are calling them as defined contribution plans, because once employer pays something, that's all. The risk is not falling on employer after that. If the risk is actually falling on employer, we are calling them as defined benefit plans. Right. Now, when these are defined contribution plans, the amounts that are payable within 12 months time, the amounts which are payable to that particular fund, external fund or insurance company within 12 months time, that portion should not be discounted. That portion should not be discounted. It should be accrued but should not be discounted. But if there is any amount which is payable, which is already due but it is payable, if there is any amount which is payable beyond 12 months time, then just imagine. So there is a timeline, this is 12 months and beyond 12 months. The portion which is payable beyond 12 months, so that has to be discounted to present value, and you have to use a suitable government bond yield rate for it. Now come to defined benefit plan. Friends, in defined benefit plan, listen carefully. Obligation arises in the period in which employee renders service. When I say that, if employee worked in this year, the obligation to pay arises. But will it fall due for payment? No, not yet. It might fall due for payment post-employment, but obligation gets created in the period in which employee renders service, not after the employee resigns or retires. So that is one point what you need to know. So when we talk about this point of obligation, that is what will determine when you have to accrue that particular expenditure. If the obligation is arising now, whether or not you pay now, you will have to accrue for it now. You get that? Right. So simply when I talk about matching concept, in this period employee put effort. So company would have got benefit from the employee in this period. Cost relating to this period, which the company may pay in the future, should also be provided now, because only then there will be matching between benefits and costs. Okay, right. Now, how will the calculation work? The accounting standard says, take a timeline and draw upon the timeline what are the amounts that might be payable over the future, and all those benefits have to be discounted to present value. All those benefits what the company may pay to the employee have to be discounted to present value. Now, benefit to employee is a cost to employer, right? So these are going to be the obligations what the company may pay in the future. So all those will be discounted to present value. Listen once again. What obligation are we talking about? For the period already served. Employee already served certain period. For this period, in the future there is an obligation. Okay, discount that to present value. Now, at the end of this particular year, say we are in the year 2, at the end of this year, present value of discounted cash flows you have. Okay, that present value of discounted cash flow you will keep aside. Maybe similar exercise you would have done in the last accounting period also, right? So, a similar exercise, okay, 1 year is completed and what would be paid in the future for this 1 year completed. So, that you would have discounted to present value and made a computation at the end of first year. Say the present value calculation at the end of first year was some 100 and present value calculation when you brought it to the end of second year, say was 250. Now, this difference of 150 is what is going to be recognized as an expenditure in year 2, right? This is called as projected unit credit method. So basically when I talk about projected unit credit method, that word sounds big, but the concept is very simple. For extra period worked, the company will have an extra obligation. That extra obligation is what has to be captured. So that extra obligation is the difference between these two and that will go into P&L. Now, you know that the present value of some amount what you have to pay in the future is 250 at the end of second year. Now, we are at the end of second year. What the company should do is they should start setting aside some money and they should start making some investments so that the company will have enough resources to be able to pay that amount when it actually falls due for payment, right? Say at the end of 8 years that amount is going to fall due for payment. So, or 10 years. So, at the end of 10 years if we have to pay that, now we should start slowly year by year, we actually start setting aside some amount and maybe purchase some government bond or make some investment into mutual funds or whatever. So, the company should actually purchase year on year certain investments so that this amount whatever is being set aside will also increase in terms of value. So, what the accounting standard calls these assets as is plan assets. We already spoke about it, right? Plan assets and qualifying insurance policies. So, the company may purchase plan assets and qualifying insurance policies so that when we have to pay money, we have money, right? Now, imagine the present worth, fair value of plan assets is 220 rupees and the present value of the amount what we have to pay in the future is 250 rupees. Our obligation is 250 rupees. So, basically closing liability is 250. Plan assets closing fair value is 220. Then, how should we actually present this in the balance sheet? The accounting standard says, don't show the assets separately and liability separately. You have to net them off and show only the net picture. Something like the way we do this kind of a thing even for taxes, right? So, advance tax and provision for tax we net off. Similarly, here this asset and liability have to be set off and net amount has to be reflected either as a liability or as an asset. In our example, because liability is more, it will be liability net 30. So, what is that liability? Provision for post-employment benefits. Like that you can create a liability. In bracket you will write net. When you write net, it is net of plan assets. And remember in the notes to accounts you will give a breakup. What is the liability portion? What is the plan assets fair value? You will give the breakup as a part of notes. Friends, if I do a calculation like this, closing present value of obligation at the end of second year is 250, that at the end of first year was 100, so difference is 150. Think about it. Actually in that 150, what all things are there? Current service cost, right? That is cost which got credited during this period. Then what else is there? We also have in this interest cost, right? We understood the concept of interest cost is also there. Then actuarial gain or loss, that also would have been adjusted in this. So, basically, and even past service cost, that also if any adjustment is there, that also goes into it. So, basically, the net impact what should go into P&L is what you are ascertaining in this discussion. And in the notes to accounts, what you should do is, there is a need to give a logical breakup of, oh, in this, in this 150 rupees of cost, this much is because of current service cost, this much is because of interest cost, actuarial gain or loss. Like this you have to give a breakup as in the notes to accounts. So friends, I am just summarizing the procedure that we have to perform under a defined benefit plan. First, for the period that is already served by the employees, you plot on a timeline when what cash flow is going to be paid out to them, right? Then discount that entire cash flow to present value using the government bond yield rate generally that is given in the question, okay? So using that you will discount this to present value. The present value what you get, the discounted value what you get, that will be called as the closing liability or obligation, right? Keep it aside. Then calculate the fair value of plan assets and qualifying insurance policies. So for the asset portion, take the fair value, calculate that, keep it aside. Difference between the closing liability and closing asset should be shown in the balance sheet. Net. If liability is more, you will show net liability in the balance sheet. If asset is more than liability, you will show net asset. Basically, that will go into the balance sheet. Then, closing liability or obligation of current year you have done. Closing obligation or liability of previous accounting period also needs to be pulled out from the records. So, in the question it might be given, or in real life if you have to do it, right? So, closing obligation at the end of previous accounting period which appeared in the previous balance sheet, or basically for that purpose you would have calculated that. Take that number. Difference between the closing obligation at the end of current period and closing obligation at the end of previous period is what should go into P&L. I am repeating, if closing obligation at the end of current period is 100, closing obligation at the end of previous period is say 70, 30 should be debited to P&L. If it is the other way around, closing obligation at the end of previous year was 100, at the end of current period is 70, then 30 will be credited to P&L, right? Now, this amount which is going into P&L, which is the difference between closing obligation of current period and closing obligation of previous period, is the net adjustment of 1. Current service cost, interest cost, actuarial gain or loss, and the adjustments whatever we do for any post service cost. Let's now talk about the next category, that is other long-term employee benefits. Friends, let's take a few examples for this. Something like sabbatical leaves or disability. Maybe somebody has some disability or they met with some disability through the employment and there is some disability benefit that is being given, or there is something like jubilee benefits we call them. So jubilee benefits are like if an employee completes 25 years, we give this kind of benefit to employee. So like this, different companies have different long-term other long-term employee benefits. Now the good news for you is the accounting treatment for other long-term employee benefits is similar to the accounting treatment what we have seen for post-employment benefits. So there is nothing dramatically new in that. And the point what you have to also bear in mind is, say suddenly in this period a new benefit is introduced, then whatever is the cost, whatever is the liability at the end of this particular accounting period, assess that, right? Standing at the end of this particular accounting period, assess the obligation, and that obligation minus opening obligation, that is the obligation at the end of previous period. If you only do something now, the previous period obligation would be 0, right? So that effectively this minus this should go into P&L. So essentially whatever you compute as the closing obligation at the end of first accounting period, the entire thing will go into P&L. Let's now come to the termination benefits. In termination benefits, as I said, the termination reason could be 2. 1, employer wants employee to leave, or employer created a plan like voluntary retirement scheme and that attracted employee to leave. So basically that is what you mean by voluntary retirement scheme. So both are covered under termination, right? Now for termination benefits, if the termination has already happened and the amount is already paid off, then expense would be debited to P&L. If cash is already paid off, then there is no longer any closing liability or obligation. But the termination event has happened, the obligation has arisen, but we have not yet settled that. Termination event has happened, but we have not yet settled that. Then you talk about a closing obligation, right? If that closing obligation is expected to be settled within 12 months time, fantastic, provide for it. It is a closing liability, but you don't have to discount it because it is going to be settled within 12 months time. But if the same closing obligation is going to be settled over a period beyond 12 months, well, then what you should do is you have to discount it to present value, and the present value of that has to be recorded. Now let us talk about a concept called curtailment. Earlier, the plan covered, say, 10,000 employees who were working with us, and maybe all the employees that were working with us were covered by the plan. Now what we have done is, say, we made that plan, we made some modifications to that plan, and we removed one category of employees from the applicability of that particular plan. So maybe some 3,000 employees out of 10,000 going forward will not be eligible for that plan. So basically what have you done? You curtailed, you minimized the obligation. So whenever there is curtailment, simple process, go to the end of that particular accounting period. Assess independently based on the revised plan. After curtailment, you have a revised plan, right? Or a revised proposal or revised policy, whatever. So based on the revised policy or proposal, assess the liability or obligation. Then at the beginning of that period, or basically end of last accounting period, what was the obligation on account of that particular plan? Say last year ending the obligation was 100. Now based on the curtailment, you realize the obligation is going to be only 70. Then that 30, whatever is the reduction in the obligation, you are going to transfer to P&L. Basically it is going to be credited to P&L. So basically curtailment, in curtailment what are we doing? We are reducing the obligation what we had in the past based on changes what we are making to the plan. Friends, I said liability from 100 is coming down to 70. That can happen with curtailments, that can happen even with settlements. Something like there is no revision to the plan to bring down the applicability of the plan. Basically you had a liability, you paid that liability. Then also the liability comes down, right? Liability settlement is different, plan curtailment is different. So when you talk about settlement, it is basically you paying that off and settling that particular liability. Basically it is you are discharging that liability. So if I talk about that from balance sheet language, in a balance sheet, if you talk about liability settlement, when you talk about settlement, what will happen? Liability will come down. Correspondingly, cash or bank also would come down. That is what will happen when liability gets settled. But when you talk about curtailment, what is happening? Under curtailment, consider it carefully. The liability comes down, but correspondingly that reduction in liability is getting credited to P&L, and P&L profit goes up. So basically here you don't have any impact on the cash or bank, it is affecting the P&L. Friends, there is a little risk of we getting confused between curtailment and past service cost. Let us just get a bit more clarity on that. In curtailment, what is happening? Under past service cost, what is happening? In curtailment, you are reducing the liability by reducing the applicability of the scheme to a fewer number of people. But if you are making some modifications to the scheme. But if you talk about past service cost, that's exactly opposite of that, where you are introducing a scheme which is going to cover employees or which is going to increase the obligation what you already had, on the basis of which fresh liability will come into existence. So basically even though both these have something like, oh, something happened in the past, something we did in the past, now we are changing. We are changing, but the question is, the change whatever we are doing, is it increasing the liability or curtailing the obligation, right? Now, friends, with respect to past service cost, two other points what you have to remember are, if the past service cost is vested on or before the end of the current accounting period, what should you do? The entire past service cost will go into P&L. But sometimes this past service cost will not be vested right away. Maybe it is going to vest over 3 years time. Then what should you do? That entire past service cost you have to amortize over that period on an equal straight line basis. So you have to charge it off over that period on a straight line basis. Friends, let's now look at actuarial assumptions. What kind of actuarial assumptions go into the calculation? Friends, all the employee related estimates with respect to demography and financial aspects go into the estimations. For example, average age of employees, average life expectancy of employees, or mortality rate, death rate of employees, the expected period for which they are going to work with the company. So that then you will have financial things like expected salary at the time of retirement, because you will make calculations, the closing salary into these many days into so many years of completed service, like that there would be a formula. So for that purpose you also need to make an estimation regarding what would be the closing salary of employee at the time of retirement. Maybe the employee is in the second year of service, you expect that employee to retire at the end of 10 years, but still you make an estimation, oh, I think at the level that person is, maybe that person might draw something like that as salary. Then expected inflation rate, expected annual hikes, all these things have to go in for the purpose of actuarial assumptions. Friends, the next aspect in the accounting standard is about return on plan assets. So how do we account for it? What is the estimated return? What is the actual return? What is the actuarial loss? How will all these things play around? So instead of talking theoretically about these, let us take one wonderful example and discuss all the aspects relating to return on plan assets with the help of that example. In January 2011, a fair value of plan asset was 10,000. On 30th June 2011, the plan paid benefits of 1900 and received contributions of 4,900. So basically into that plan we paid 4,900, we are the employer, we paid 4,900, but from the plan we got 1,900. So basically extra, how much did we pay? If you see that way, extra amount of 3,000 went from our side into the plan. Okay, right. Then at 31st December 2011, the fair value of plan asset was 15,000 and present value of defined benefit obligation was 14,792. Actuarial losses on the obligation for 2011 were rupees 60. Okay. At 1st January 2011, the reporting enterprise made the following estimates based on market prices on that day. Interest and dividend income after tax payable by the fund is 9.25%. Realized and unrealized gains on plan assets after tax is 2%. Then administration costs could be 1% and expected rate of return for 1 year is 10.25% and expected rate of return for 6 months is 5%. For 2011, the expected and actual return on plan assets should be computed. Now, how should we calculate? Now, listen carefully, concentrate on this. We had 10,000 as the opening balance. On 10,000, entire 12 months we can earn, for the entire 12 months period we can earn return. At what rate? 10.25%. Apply 10,000 into 10.25% into 12 by 12. That will be 1025. Then on extra 3,000, I told you what that 3,000 is, right? So basically it is the difference between 4,900 and 1,900. That 3,000 was employed into the plan, basically it was invested back into the plan somewhere mid of the year. So for that 3,000, interest rate is 5% for 6 months. Okay. So what we should do is 3,000 into 5% into, basically that's a 6 months rate. So that comes to 150 rupees. Now, what is the total expected return on plan assets for the entire year? 1025 plus 150, 1175. Excellent. What is the fair value of plan assets at the end of the year? 15,000. 15,000 is the fair value at the end of the year. What was the fair value at the beginning of the year? 10,000 was the fair value at the beginning of the year. Acha. Can I say that entire 5,000 rupees is what we earned? No. Entire 5,000 rupees is not what we earned, because we further made a net investment of 3,000. because we made a further net investment of 3000. What is our actual return on plan assets? Our return on plan assets, if you see as a net amount, it is only 2000 rupees. So 10,000 was there from the beginning, 3000 is the net amount, 3000 is the difference between 4900 and 1900. That got employed on 30th of June, and so basically totally about 10,000 plus 3000, 13,000 was invested, and that became 15,000. So basically what is the actual return on plan assets? 2000 is the actual return on plan assets. Now look at this. What was our expectation? Our expectation was only 1175. What is the actual? Actually is 2000. Now, what is the difference you see? Is it good for us or bad for us? Good for us, right? Obviously, because we are getting more. What is the benefit we are getting? 825 is the benefit what we seem to be getting. But in the question, we know that there is an actuarial loss on obligation. So this is on plan asset. There seems to be an estimation gain, or because of this actuarial gain or loss, in the actuarial gain or loss calculation, we have an actuarial gain on plan asset to the extent of 825, and we have an actuarial loss to the extent of 60. So basically you have to net these off, and that net amount of 765 should be charged in the P&L. Friends, the last aspect of the standard is about the disclosures, right? So we will understand the crux of what all aspects need to be disclosed. Look at this. Disclosure of different components of cost to be charged to P&L. So basically you need to give a breakup of what is the cost on account of current service cost, then interest cost, then actuarial gain or loss, then past service cost, impact of curtailments, all those things have to be disclosed. Then disclosure and breakup of actuarial assumptions. The assumptions used have to be disclosed in the notes. Then discounting rates as per yield on government bonds. So that rate also has to be given. Then actuarial assumptions may be reviewed by management or auditors, and if there are any special points regarding actuarial assumptions, those points also you will disclose. Then benefit obligations and plan assets to be separately disclosed in the notes. The netting and netting off is something which will come into balance sheet, but in the notes you have to separately disclose. Then nature of defined benefit plans and effect of changes, if any, in the defined benefit plans have to be disclosed. Then breakup and reconciliation of different components of defined benefit obligation, that also needs to be given. Then breakup and reconciliation of different components of plan assets and return on plan assets, and also the accounting policy regarding overall AS15 related aspects has to be disclosed. Now friends, this is like a summary of the important points what you need to remember. I would strongly encourage that you look at the balance sheet notes with respect to say companies like Infosys or Wipro or TCS, one of these companies. Just have a look at the notes, and there you will find actually how the disclosures are given, and that will add a lot of value into your learning process. That's it. That's about accounting standard 15 on accounting for employee benefits. Let's now look at a few past examination questions from AS15. A company has a scheme for payment of settlement allowance to retiring employees. Under the scheme, retiring employees are entitled to reimbursement of certain travel expenses for a class they are entitled to as per company rule, and to a lump sum payment to cover expenses of food and stay during the travel. Alternatively, employees can claim a lump sum amount equal to 1 month pay last drawn. The company's contention in this matter are settlement allowance does not depend upon length of service of employee. It is restricted to employees' eligibility under travel rule of the company, or where option for lump sum payment is exercised equal to last pay drawn. Since it is not related to length of service of employee, it is accounted for on claim basis. Basically, the company is not accounting for it. State whether the contentions of the company are correct as per relevant accounting standard. Give reasons in support of your answer. So look at what the company is saying. It doesn't depend on the length of service because it's just based on the pay, etc. is what the company is saying. That is the first contention. Friends, think about it logically. The last drawn salary indirectly will be dependent on what? Will be dependent on the expected length of service of the employee. So if the employee joins in the first year, leaves the company in the first year, last drawn salary says 10,000. That employee works in the company for 10 years and leaves the company after 10 years, maybe the last drawn salary per month is 1 lakh rupees. So even though directly you may not find the relevance, indirectly the length of service is relevant. So the first contention of company is not correct. Now let us come to the second contention. So the company says, I will pay that amount whenever the employees claim. Now friends, this actually falls under defined benefit obligation. And if that amount is immaterial, let us for a moment assume, if that amount is immaterial, it's not significant much, it's not much of much significance, then you do pay as you pay as you claim or account as you claim, all those things would be okay. But if that amount is material, then what? Accounting standard says, if that is material, consider it as a defined benefit obligation. You might have to get an actuarial valuation done to ascertain the liability and the corresponding expense. So without that, how will it be correct? So you will have to accrue it in the period and you have to proportionately. So if the employee is working for 10 years and then the employee is expected to get this, then for every year of service, there is certain amount which has to be accounted for as a provision for employee benefits. So friends, if that amount is material, we cannot simply say, I will pay and account whenever the employee claims. No, that cash basis does not work. Accrual has to be done by using actuarial assumption and the principles given in the accounting standard under defined benefit obligations. So even the second contention of the company is incorrect. Friends, now let us talk about a small concept, and that concept will actually be relevant for the next problem what we are going to solve. Say, you invest 100 rupees on 1st January and the interest rate is 5% for 6 months. Listen carefully, 5% for 6 months period. So then what will happen at the end of 6 months? What will be the interest? 100 plus 5%, which will be 105. At the end of 6 months, the amount in your bank account will be 105. Now imagine this 105 is invested for 6 more months at same 5%. This 105 is invested at same 5% for the next 6 months. What will happen to the balance at the end of the year? The balance at the end of the year will not be 110. The balance will be 110.25. 110.25, because even on this 5 rupees of interest, again interest will get calculated, right? So it will be 110.25. So basically, if 5% is the half yearly interest, the annual interest considering half yearly compounding will be 10.25%. So 100 became 110.25%. So here what actually happened? Simply half yearly compounding is what has happened. Okay, this is one concept what I want you to know. Now let us look at the next problem in which we will apply this concept. As on 1st April 2008, the fair value of plan assets was rupees 1 lakh in respect of pension plan of Zelius Limited. On 30th September 2008, the plan laid out benefits of 19,000 and received inward contributions of 49,000. What do we mean by this? First, let's just stop here and understand. Opening balance of fair value of plan assets 1 lakh. So our plan assets were 1 lakh opening balance. Then on 30th September, so after 6 months, what is the situation? Plan paid out benefits. When I say paid out benefits, whom is the plan going to benefit? Employees. So 19,000 is our outflow and received inward contributions of 49,000. Who will give these inward contributions? Company will give these inward contributions. So company gave 49,000 or set aside 49,000 towards employee benefits, paid out 19,000. So what is the net? Net 30,000 is the extra cash what the company has for investment, and this extra 30,000 is going to be invested only for 6 months, not for the full year. Okay, be clear about that. Then next point. On 31st March 2009, the fair value of plan assets was 1,50,000 and present value of defined benefit obligation was 1,47,920. Actuarial losses on the obligations for the year 2008-9 were rupees 600. On 1st April 2008, the company made the following estimates based on its market studies, understanding and prevailing prices. Interest and dividend incomes after tax payable by the fund 9.25%. Realized and unrealized gain on plan assets after tax 2%. Fund administrative costs 1%, expected rate of return 10.25%. We are required to find out the expected and actual returns on plan assets. Friends, I spoke about a concept just before starting this problem. There is something called as expected return on plan assets given to you at 10.25%. Now friends, 10.25% must have been the annual expected return. Something like if you invest some money at the beginning of the period, you will get 10.25%. Now, the question is this: what is the opening balance of our plan assets? 1 lakh rupees. On 1 lakh rupees, we will earn 10.25%, that is straightforward, right? But there is a net amount of 30,000. We discussed this, 49,000 minus 19,000. Net amount of 30,000 which we will have for investment from 30th of September. So basically from half year, at the end of half year we will get 30,000 rupees for investment. So on that amount, how much of return do we get? We will get only 5% return. That is one point I want you to know. So we will get only 5% return on that. So on that 30,000, we should calculate only 5% of return. So now let us look at the calculation. 1 lakh into 12 by 12 into 10.25%, which will be 10,250, plus 30,000 into 5%. 30,000 into 5%, we understood the calculation. So that comes to 1,500. So total expected return on plan assets is 11,750. Friends, we expected 11,750 of return. But actually how much did we get? For that, let us just make a small ledger account. It is not a ledger actually, but just for our understanding. It is an asset account, right? In this asset account, opening balance is 1 lakh. Closing balance in this asset account is 1,50,000. Then, an addition that happened to the asset is 49,000. Something like if you purchase an asset, that is like an addition to asset, right? Similarly, the company made fresh contribution into the plan assets. So that is like an addition to the asset. So addition that happened is 49,000. So right here. Then out of the amounts what we had, some portion was paid out. So some portion, as if an asset is sold, some portion of 19,000 was paid out. So write that here. 19,000 is the amount paid out in the form of benefits to employees. Now, what is the balancing figure? That balancing figure of 20,000 is the benefit what we got on the plan assets actually. So 20,000 is the actual benefit, but our expectation was only 11,750. The following data applies to X Limited, defined benefit pension plan for the year ended 31st March 2009. Calculate the actual return on plan assets. Just now we solved a problem like that, right? Benefits paid 2 lakhs, employer's contribution 2,80,000, Fair market value of plan assets on 31st March 2009, 11 lakhs 40, and fair market value of plan assets on 31st March 2008 is 8 lakhs. Okay. Again, let's draw an asset account, plan assets, right? So, let's draw plan assets account in a ledger form. Opening balance 8 lakhs, closing balance 11 lakh 40,000. Addition to the asset, what is the employer's contribution? 2 lakh 80. What is the deletion to the asset? Amounts paid 2 lakhs. What is the balancing figure? What is the balancing figure? That is the actual return on plan assets, that is 2 lakhs 60,000. So, that is the addition which happened to the asset in the form of return on plan asset. Balancing figure. Let's look at the next problem. Kumar Limited is an engineering company. The company received an actuarial valuation for the first time for its pension scheme, which revealed a surplus of rupees 6 lakhs. It wants to spread the same over the next 2 years by reducing the annual contribution to 2 lakhs instead of 5 lakhs. So, basically 6 lakhs they want to spread over 2 years, 3 lakhs now and 3 lakhs in the next year. So, in the current year, if 5 lakhs is the contribution that the company has to account for, they are saying no, it's not 5, only 2 we will account for. So, 3 they want to take in the current year, they want to reduce the contribution. Okay. The average remaining life of the employee is estimated to be 6 years. You are required to advise the company. Friends, what does the accounting standard 15 tell us? We don't have the option of deferring this 6 lakhs over 2 years. So, that entire 6 lakhs impact has to come into the current accounting period only. So, if the amount of 6 lakhs is what is ascertained as surplus, that entire surplus technically is credited to P&L or reduced from cost. Z Limited changed its employee remuneration policy from 1st of April 2012 to provide for 12% contribution to Provident Fund on leave encashment also. As per the leave encashment policy, the employees can either utilize or encash it. As at 31st March 2013, the company obtained an actuarial valuation for leave encashment liability. However, it did not provide for 12% PF contribution on it. The auditor of the company wants it to be provided, but the management replied that as and when employees availed leave encashment, Provident Fund contribution was made. The company further contends that this is correct treatment as it is not sure whether the employees will avail leave encashment or utilize it. Comment. Friends, in this question, the first thing what we have to ascertain is whether the employee benefit includes leave encashment. Does it include leave encashment? Yes, it does. So, that part is taken care. These leave encashments etc. get covered under employee benefits. And now the next aspect is the company's contention is something like this. It says, I will account for leave encashment only when the employee actually avails it, because I don't know whether the employee will actually use that leave or encash that leave. That is the main problem that the company is saying. Friends, there is one more cliff to it. It says, one more attachment to it. It says, oh, even that PF of 12% will be paid only at that time. Okay. Now, the simple answer is this. Accrual concept has to be followed. Accrual concept has to be followed. And the amount of estimated expense has to be provided for today, and basically expense and liability recognition should happen today. And to make that expense and liability estimation, you can probably take the help of probability theory. You can use actuarial assumption, which of course will consider probability theory. What is the probability that employee will actually use that particular leave, basically take leave and exhaust that leave? And what is the probability that employee will not take leave? Employee instead will take cash, will take money for the period of leave. So, leave encashment. So, what is the probability for this? What is the probability for this? The same probability. We understand. Exact amount nobody knows. But best estimate has to be made considering actuarial assumptions. So, friends, that's the point here. The company cannot simply say, oh, I will not provide for it at all. how can you not provide for it at all? We have to use the best estimate, accounting estimate, using actuarial assumptions and account for it, and company's contention is not appropriate. Is auditor's contention appropriate? Yes. Auditor is saying you have to provide for it. So, auditor's contention is appropriate, the company's contention is not appropriate. Let's look at the next problem. P Limited has 3 business segments which are FMCG, batteries and sports equipment. The battery segment has been consistently underperforming, and P Limited, after several discussions with labor unions, have finally decided on closure of this segment. Under the agreement with the labor union, the employees of the battery segment will earn no further benefit, as the arrangement is a curtailment without settlement, wherein the employees of the discontinued segment will continue to receive benefits of services rendered when the segment was functioning. As a result of curtailment, the company's obligations that were arrived on the basis of actuarial valuation before the curtailment have come down. The following information is also furnished. The value of gross obligation before curtailment calculated on actuarial basis was rupees 4,000 lakhs. The value of unamortized past service costs is 100 lakhs. Curtailment will bring down gross obligation by rupees 500 lakhs, and P Limited anticipates a proportional decline in the value of unamortized past service costs also. The fair value of plan assets on date is estimated at 3250 lakhs. You are required to calculate the gain from curtailment and also show the liability to be recognized in the balance sheet of P Limited after curtailment. Let's now calculate gain from curtailment. Okay, so let's have particulars. Before curtailment, after curtailment, and we will have the last column, impact of curtailment. Okay, so let's first look at the gross obligation. Gross obligation is basically like a liability. Earlier, our obligation or liability was 4,000 lakhs, that is before curtailment. After curtailment, what happened? Look at the third point. Curtailment will bring down gross obligations by 500 lakhs. So, 500 lakhs will come down. So, 4,000 minus 500, that will be 3,500. So, after curtailment, the gross obligation would be 3,500. So, what is the benefit we got on account of curtailment? Impact of curtailment, our liability came down. Liability coming down is a benefit, right? So, benefit, or you can say curtailment gain of 500. Great. Now, come to fair value of plan assets. What is the fair value of plan assets? That's given in the fourth point. That is 3250. 3250, will that change because of obligation coming down? No. So, the obligation came down, but what you invested, suddenly why will that come down? Nothing will happen to fair value of plan assets. Right. Now, come to the other point. Unamortized past service cost. Unamortized past service cost. It is something like an expenditure which is not yet amortized, which is not yet charged off. So, it's something like, for a moment, let us consider that as an asset. Okay, it's not an asset actually, but it is a reduction from liability. So, reduction from liability, just mathematically I am viewing it as an asset. Okay, right. Now, for 4,000 lakhs of obligation, the unamortized cost was 100 lakhs. For 3,500 lakhs of revised obligation, how much will that be? Like this, we are trying to make a calculation. That comes to 87.5 lakhs, right? So, simple, 100 into 3,500 divided by 4,000. So, that is 87.5 lakhs. So, now friends, the asset is decreasing from 100 to 87.5. So, reduction in asset is 12.5. Reduction in asset is 12.5. Okay. Now, listen carefully. the impact till now we captured two aspects. Curtailment gain benefit 500 lakhs, the reduction in the asset 12.5, which is like loss, right? So now if you talk about impact or net effect of curtailment, it is 500 minus 12.5, which is 487.5 lakhs. Excellent. Now what should the revised obligation be or revised liability be? That will be 3500 minus 3250, right, minus 87.5, so that will be 162.5. So basically from the obligation what we had, we subtracted actual asset what we have, right, liability minus actual asset, fair value of plan asset that we subtracted. And what is the other thing that we subtracted? The unamortized portion of past service cost. I said mathematically that is also something like an asset, even though for presentation purpose it is shown as a reduction from liability, it is also like an asset. It is not yet, it's an asset not yet charged off to P&L, something like that. You have that as an asset, so that portion also you are reducing. So essentially 3500 minus 3250 minus 87.5, that makes it 162.5 lakhs. An employee, Darshan, joined a company PQR Limited in the year 2014. The annual emoluments of Darshan as decided is rupees 15,52,303. The company also has a policy of giving a lump sum payment of 25% of the last drawn salary of the employee for each of the completed years of service if the employee retires after completing minimum 5 years of service. Salary of Darshan is expected to grow at 10% per annum. The company has inducted Darshan in the beginning of the year and it is expected that he will complete the minimum 5-year term before retiring. What is the amount the company should charge in its profit and loss account every year as cost for defined benefit obligation? Also, calculate service cost and the interest cost to be charged per year, assuming a discount rate of 8%. Friends, today Darshan's salary is 15,52,303. If this person is going to serve at least 5 years, then what is the last drawn salary when it is given that every year salary will increase by 10%? So you can take the calculator, 15,52,303 plus 10%, like this you will add for 5 years. Or you can simply say 15,52,303 into 1 plus 0.1, because it is 10%, I am writing it as 0.1 whole to the power of 5. That's also, it is going to increase 5 times. So what is that coming to? That answer comes to 25 lakhs, right? So last drawn salary of this person Darshan is expected to be 25 lakhs. Then what is the defined benefit obligation? 25 lakhs into 25% of that, that's given in the question, right? Into number of years completed, at least 5 years we say, okay, into 5, 25 lakhs into 25% into 5 years, which will be 31 lakhs 25,000. So friends, now let us discuss the logic as to how you are going to proceed with this problem. Let us draw a timeline, year 1, 2, 3, 4, 5, and at the end of 5 years, you would pay 31 lakh 25,000. That's the point what you have to bear in mind. Now, you will pay 31 lakhs 25,000 for what? For 5 years of service. So, per year of service, how much are you paying? 6 lakhs 25,000 is what you are paying at the end of 5 years per year of service. So, 6 lakhs 25,000 into 5 is what? You arrive at 31 lakhs 25,000. So, friends, what I am essentially saying is, each year when the employee completes that is contributing to 6,25,000 what the employee will get at the end of 5 years. Listen carefully. If employee completes the first year, at the end of 5th year, employee will get 6,25,000. If the employee completes second year, then employee, because for this additional year completed, would be entitled to another 6,25,000. Then third year, another 6,25,000. Like this, if the employee completes 5 years, then 31,25,000 is what the employee is entitled to. That is the logic, right? Now, friends, when I have to account for something at the end of first year, basically I am talking about current service cost. 1 year completed, that is why in the future there is an amount what the employee is going to get. Now 6,25,000 employee is going to get at the end of 5th year. I am at the end of first year. How much should I account for now is the question. The accounting standard says, discount that 6,25,000 to present value and account for it. That's it. So 6,25,000, if you discount to present value, at what rate should you discount? It's given in the question. 8% is the discount rate. So simply 1 divided by 1.08, press is equal to, on the calculator 4 times, is equal to. You will get the present value factor. Multiply that with 6,25,000, you will get the present value of cash flow, which you have to recognize as an expense and a liability in the first year, right? That is the current service cost. Similarly, when you come to second year, you would say, what is the current service cost of second year? Current service cost of second year will be, for completing second year, 6,25,000 more will go to the employee at the end of 5 years, right? So that 6,25,000 you should discount by how many years? 5, 4, 3. By the time you come to beginning of 3, it is end of second year. So you have to discount it 3 times. So for this it will be 1 by 1.08. You will press is equal to 3 times, is equal to, we will discount it by 3 times into 6,25,000. That is going to be the current service cost for the second year. Come on, let us do a calculation like this. So at the end of first year, 6,25,000 into, what is the present value factor? 1 by 1.08 to the power of 4. So that is 0.735. So the current cost, current service cost as we call it, is 4,59,375. Then in the second year, 6,25,000 discounted by 3 terms, discounted for 3 years. That will be 4,96,250. Third year, discounted by 2 terms. That will be 5,38,625. Fourth year, you will discount it only for 1 term. That will be 5,78,750. Whatever is at the end of 5th year, well, there is no question of discounting. So that will be 1. So that will be 6,25,000. So these are the current service costs. Now the question talks about one more point. It talks about interest cost also, right? Now friends, for convenience sake, if I say in the first year it is around 4,59,000, but actually at the end of 5th year the same amount is becoming how much? 6,25,000. So gradually it is increasing and reaching 6,25,000. Every year that increase whatever you see, that increase is what we call as interest cost. Simply put, 6,25,000 minus 4,59,000 approximately is the total interest cost which will go into each of these years. So gradually in each year, how much interest should be recognized? Let us make a table and understand that calculation. So assume at the beginning of first year, there is nothing which was payable. There is no obligation at all. So 0. Then what is the interest cost on that? If opening balance is 0, interest cost also is 0. So interest cost at 8% on 0 is 0. Now during current year, now we have a column called as current service cost. We already calculated that. 4,59,375. It's something like this. Employee says, hey company, you have to pay this much amount to me. So for a company it is payable. So as if company now has a liability. Let's just view it as loan, whatever is that amount, as if company has taken a loan of 4,59,375 because it is payable. Okay, right. So then what is the closing balance? Closing balance will be 4,59,375 only at the end of first year. Excellent. Now come to the beginning of second year. Opening balance is the closing balance of last year. Fine. Then what is the interest cost? Interest cost is 8%. Acha. So 36,750 is the interest cost. Okay. Now what is the current service cost of second year? We already calculated that. Current service cost of second year is 4,96,250. It is as if an extra loan was taken by the company at the end of second year, which is 4,96,250. Okay. Now opening there was a loan of 4,59,375 plus interest got added. To that we took extra loan. So what is the closing balance? Closing balance is 9,92,375. Excellent. Now friends, I am just repeating the logic. Listen carefully. Already there was an opening loan. On that opening loan there is some interest at 8%. We are calling it loan because this is an amount payable to employee. There is an opening loan. On that there is an interest at 8%. We didn't pay anything. Over and above that we have drawn fresh loan because there is a fresh payable to employee which is coming up. So closing balance became 9,92,375. Fantastic. Now come to the third year. The closing balance of second year will become opening balance of third year. On that opening balance, apply 8%, which is the third year interest. That comes to 79,390. That is the third year interest. Then we didn't pay the opening balance. We didn't pay this interest. Over and above all this, we took a fresh loan in third year. Fresh liability came in third year. How much is that? 5,35,625 is the fresh liability which is coming into third year. Acha, this is a fresh liability. So closing balance at the end of third year is 16,07,390. I hope it's clear. Okay. Similar logic you apply for fourth year and fifth year also. Then at the end of fifth year, what is the closing balance? At the end of fifth year, the closing balance is 31,25,000. So that is the amount which has to be settled. Friends, I will give you a small tip, examination trick which will help you after all these calculations to know whether your answer is correct or not. Listen carefully. 31,25,000 is the total cost which should be debited to P&L over 5 years time. That is the first point. Okay, right. Now you made two tables. First table is for current service cost and second table is for interest. Total up all the amounts in the current service cost. Total up all the amounts in the current service cost. That will come somewhere close to 26,95,000. Check that calculation yourself. 26,95,000. Then total up all the amounts in the interest cost, interest column. Okay. So when you do it in exact calculation, it will come somewhere close to 4,30,000. Close to 4,30,000. Actually, the total of these two is our 31,25,000. So basically what happened? You split that into current service cost portion and interest cost. While both these things will get debited to P&L, current service cost of first year plus interest cost of first year, both will go into P&L. If there is any actuarial gain or loss, that also will go into P&L. But for disclosure purpose, in the notes to accounts, you need to give breakup. So how will you get breakup? If you do a problem like this, you will understand how you have to give that breakup, how you can arrive at those numbers which you can show as a breakup in the notes to accounts.